Imagine this. You're driving down a long highway, the sun is setting, your favorite song is playing, and you feel completely at ease. But suddenly, the road ahead seems unclear. A fog rolls in. Just like that drive, life is often a journey where everything seems smooth until uncertainty clouds our view. And when it comes to managing our finances, we face similar foggy moments, moments that ask us to confront financial risks. Now, let me take you back to a time when I faced this financial fog myself. It was a few years ago, and I had just started investing in the stock market. At first, I felt invincible. Every decision I made seemed to pay off, and I could see my wealth growing. But I was so focused on the returns, like our favorite song on the radio, that I overlooked the importance of understanding and managing the risk that came with those decisions. Then, the market took a sharp turn. Suddenly, my investments didn't look so promising. I remember staring at my computer screen, feeling a mix of fear and regret, wondering where I went wrong. That experience taught me a critical lesson. Financial risk isn't something to fear or ignore. It's something to understand, anticipate, and manage. Just like how you'd keep your headlights on and slow down when driving through fog, you need to adjust your approach to investing when uncertainties arise. So, let's talk about how you can manage financial risks effectively, using lessons from real life, financial markets, and the psychology of money. First, let's define what we mean by financial risk. At its core, risk is the possibility that your investments will not perform as expected. This can mean losing money or not gaining as much as you had hoped. Risks come in various forms: market risk, credit risk, liquidity risk, and more. Understanding these types is like knowing the different road conditions you might face on your journey. Market risk, for instance, is the risk of your investments declining due to economic factors, much like how rain can make a road slippery. One powerful mental model to consider when managing risk is diversification. You've probably heard the saying, "Don't put all your eggs in one basket." In financial terms, this means spreading your investments across different assets to minimize the impact of a loss in any one area. If one part of the market has a downturn, other parts might balance it out. Diversifying is like having multiple options for reaching your destination. If one route is blocked, you have alternatives. Another crucial aspect is understanding your own risk tolerance. This is a bit like knowing how comfortable you are driving in challenging conditions. Some of us are more risk-averse. We prefer the sure and steady path over the thrilling but uncertain detour. Knowing your risk tolerance helps you make investment decisions that align with your comfort level, ensuring you don't lose sleep over your financial choices. Let's delve into money psychology, a topic that often comes up around midnight when you're reflecting on life. We humans have an interesting relationship with money. It can bring out both the best and the worst in us. Fear and greed are two powerful emotions that heavily influence financial decisions. Fear can paralyze us, leading to inaction, while greed can make us reckless, pushing us to chase returns without considering the risk. Finding the right balance between these emotions is key. Think of it as maintaining the right speed on the highway, not too fast, not too slow. One technique I've found helpful is setting clear, long-term financial goals. When you have a destination in mind, it's easier to endure short-term bumps in the road. For example, if your goal is to retire comfortably, reminding yourself of this can prevent panic during market downturns. It's like having a map that keeps you focused on the bigger picture, even when the journey gets tough. Let's consider a real-life example, the 2008 financial crisis. It was a time when many people saw their investments plummet. The fear was palpable, and the temptation to pull out of the market was strong. But those who understood that markets are cyclical and stayed the course often found that their patience paid off in the long run. This is a reminder that sometimes the best decision is to stay committed to your long-term plan, even when the current situation is unsettling. Recently, I witnessed a friend navigating her own financial journey. She wanted to start investing, but was terrified of losing money. Together, we worked on creating a diversified portfolio that matched her risk tolerance. By taking small, informed steps and educating herself about the market, she gradually built confidence. Soon, the fog began to lift, and she could see the road ahead more clearly. Managing financial risks is an ongoing process. Regularly reviewing your investments, staying informed about market trends, and adjusting your strategies as needed are all part of this journey. Remember, it's not about eliminating risk entirely. That's impossible. It's about understanding and managing it so that it doesn't derail your financial goals. As we wrap up this late-night chat, I want to leave you with this thought. Managing financial risk is much like mastering a craft. It takes time, patience, and practice. Every challenge you face is an opportunity to learn and grow. Just as drivers become more skilled with experience, you'll become more adept at navigating the financial landscape the more you engage with it. So next time you find yourself in a financial fog, remember to slow down, check your bearings, and trust in the tools and knowledge you have. Just like every journey, it's not only about reaching your destination, but also about how you travel along the way. Whether it's the thrill of investing or the satisfaction of seeing your wealth grow sustainably, embrace the ride and make the most of every moment. Let's dive back in and explore more about managing financial risks. We've touched on understanding what financial risk means and recognizing it in our daily lives. Now, let's talk about another significant aspect: how our emotions play a role in our financial decision-making. Imagine this. You're at a store and there's a big sale. You see a gadget you've been eyeing all year, and it's half off. Your heart races, your mind is buzzing with excitement, and you feel an overwhelming urge to grab it. This is a perfect example of how emotions can influence our financial choices. The thrill of a sale can make us overlook our budget or forget about other financial priorities. To manage financial risks effectively, it's crucial to acknowledge these emotional triggers. One helpful strategy is to implement a cooling-off period before making significant purchases. This means giving yourself a day or two to think about the decision. Often, this pause helps us evaluate whether the purchase truly aligns with our financial goals or if we're simply caught up in the moment. It's also important to address the fear of missing out, often abbreviated as FOMO. This feeling can push us to make hasty financial decisions, like investing in a buzzworthy stock because everyone else is doing it. But remember, what's popular isn't always what's best for you. Take time to research and understand any investment you're considering. Ask yourself, does this align with my long-term goals? Can I afford this risk? Another aspect of managing financial risk is building an emergency fund. Think of this as your financial safety net. Life is unpredictable, and having a stash of money set aside can help cushion the blow of unexpected events, like a car repair or medical bill. A good rule of thumb is to aim for 3 to 6 months' worth of living expenses. This might sound like a lot, but you can start small. Even a few dollars a week can add up over time. Let's also touch on the idea of diversification. Simply put, it's about not putting all your eggs in one basket. When you diversify, you're spreading out your investments so that you're not relying on a single source for all your returns. This can help reduce risk because if one investment doesn't perform well, others in your portfolio might do better. And finally, let's revisit the importance of knowledge. The more you know about your financial situation and the risks involved, the better equipped you are to make informed decisions. This might mean reading up on a new investment opportunity or consulting with a financial advisor who can offer personalized guidance. Remember, managing financial risks isn't about avoiding risks entirely. It's about understanding them and making decisions that keep you on the path toward your goals. Financial decision-making can be a personal journey, and it's okay to seek help along the way. Whether you're just starting to think about your financial future or refining your strategy, every step you take brings you closer to financial confidence and security. Keep learning, stay curious, and be kind to yourself as you navigate your financial path. Absolutely. Let's dive back in. We've been exploring the landscape of managing financial risks, and I want to touch on something that's often overlooked, the emotional side of money. You see, when we think about risk, it's not just about numbers or probabilities. It's also about how we feel. Our emotions can drive our financial decisions more than we might realize. Have you ever hesitated to invest in something because of fear, or maybe held onto a stock longer than you should have because of hope? That's your emotions talking. It's completely natural to feel anxious when it comes to money. After all, there's a lot at stake. But here's the thing. Understanding why we feel the way we do is the first step to managing those emotions effectively. It's about recognizing that these feelings are just part of the process. They don't have to dictate our actions. One way to manage this is to set clear financial goals. Knowing what you're aiming for helps you stay focused, even when emotions run high. Let's say your goal is to save for a new home. When you're clear on that goal, you can remind yourself of it whenever you feel tempted to spend impulsively or when market fluctuations start to worry you. This clarity acts like a compass, guiding your financial decisions. Another tool to keep those emotions in check is education. The more you know, the less intimidating the financial world seems. Build your knowledge slowly and steadily. Listen to podcasts, read books, follow trusted sources. The more informed you are, the more confidently you can make decisions. Understanding that the market goes up and down, for instance, helps you not to panic during a downturn and maybe even see it as an opportunity. And then there's the power of planning. A well-thought-out plan gives you a framework to follow. When you've done the homework, you can lean on your plan when uncertainty hits, reducing the impulse to react purely out of emotion. It's also helpful to establish a support network. This could be a financial advisor who aligns with your goals, or a community of friends and family who understand your aspirations. Having people to talk to can provide both reassurance and accountability. Lastly, be kind to yourself. Mistakes will happen. It's part of the journey. What matters is how you respond and learn from them. Managing financial risks is about progress, not perfection. So next time you feel a wave of financial anxiety, pause. Take a deep breath, come back to your goals, lean on your plan, and remember that your emotions, while important, are just one piece of the puzzle. You're in control, and with a bit of awareness and the right tools, you can navigate the financial seas with greater ease and confidence. Thank you for joining me today. I hope this helps you on your journey to manage financial risks with clarity and calmness. Keep learning, keep growing, and remember, you've got this. Until next time.